Hey ladies and gentlemen, it's Darryl Barnes, the president of Deacon Wealth Management. And today I wanted to go over the 2023 mid-year outlook. Now, LPL's research department does strategic tactical asset allocation management, and they have a committee for that. So we're going to utilize the information that they've given us. I'm going to post this on our website. There's going to be a link here in this video, but you're always welcome to call us at 540-371-8585. And again, we're at Deacon Wealth Management. And let's just talk about the economy really quickly. My goal here is to make sure I can get through this very quickly for you. And if you would like more details, click on that link and you'll be able to access these individual charts as we go along. But the economy is kind of an interesting scenario right now. The thing that's been on the front burner for quite some time has been inflation. And the inflation numbers just came out. Right now, the CPI is at 3.8%, okay? That doesn't sound like a bad number, but you have to kind of look at that in historical numbers. For instance, in the late 70s, we had inflation running at 7.6%, 11.3%, 13.5%, and 10.3% in successive years, okay? When we have one increase, that is year over year. So that was a substantial period of inflation, and we really had to deal with that. So when we're listening to politicians and they start talking about, oh, well, inflation's only 3.8%, well, that's 3.8% on top of the, I believe the number's 8%. Yes, 8% last year, which was on top of 4.7% the year before. So inflation is still something that we need to beat. When we are managing assets in portfolios, what we're trying to beat are taxes and inflation. If we can stay ahead of those two items, we can typically stay ahead in our portfolios so that we can create a larger pool of money from which to create income. And I just wanted to throw those numbers out there because inflation's not gone away. And I don't think it's going to go away anytime soon, but we need to address it. And one thing that's really good about stocks is stocks are nice hedges for inflation because inflation is measured in dollars, stock prices are measured in dollars as well. So we're actually seeing the stock market make a nice little recovery here halfway through the year. We didn't quite expect such a good return, but I think we've got a few things working for us in our favor, for lack of any better terms. So when we start to think about where can you get your highest and best returns, there are four places to create wealth. One's in real estate, one is owning your own business, one is having a unique talent or unique skill that you get paid for, and the other's in the financial markets. And that's why I think the financial markets have done pretty well because inflation is trying to be controlled by the Fed, so the Fed continues to increase interest rates. As interest rates go up, it makes the size of the home that you can afford or the price of a home that you can afford go down. So we're starting to see those competing assets not be as attractive as the stock and bond markets. At the same time, there's about $5 trillion sitting around in money markets right now waiting to be invested. So those are the good things that are out there. I think we're also seeing a little fear of missing out. So folks that have been sitting on the sidelines have been chasing this market a little bit. And we've seen some pretty substantial increases. We're not going to poo-poo those increases because we always like it when our numbers go up. I'm just not sure we're going to see the same level of strength in terms of the growth for the next 6 months. I think we're going to see good, steady growth, but I don't think we're going to see tremendous growth. So we're going to keep an eye on that. One thing that everybody is talking about is, are we going into a recession? Recessions are typically foreshadowed by inverted yield curves, which means the bond market short-term interest rates are higher than long-term interest rates. That has been out there for at least the last 9 or 12 months at this point. But we're also starting to see small businesses start to limit the amount of hiring that they're doing. So if you look at that in a vacuum, that really says, hey, we are going to have a recession. The smart money, I guess you'd say, is betting on a slight recession. And I think we're going to see it. We've seen a little bit of the technical aspects of a recession already. I think if the regulatory environment doesn't ease up a little bit, you're seeing more regulations get put on business every day, which is making it tougher for them to operate and increase their earnings. And typically increases in earnings push stock prices up. Decreases in earnings typically push stock prices down. So we'd like to see a little freer tax situation and a little freer regulation situation. One thing that I find interesting is the pulse of the American public. And where I grew up, we grew up in a pretty rural place, but it was kind of suburban. But now we're seeing so many multi-family housing units come together that I think once people are starting to live closer together, that the way that they live their lives changes. So I think you're starting to see a little bit of conflict there. I think that's what has created some of the conflict that we see in the larger cities. But I think that's going to continue because multi-housing units are actually being built faster than single-family units. It's one of the few times in history we've seen that, but we're seeing a lot of real estate investment trusts build these larger units. So that's something else to kind of keep an eye on. And we're starting to see spending recover. Pre-pandemic, our spending was at a certain level. We've actually reached back to that same level. It's taken us a couple of years, but there we are. And to get back to the stock market, we hit something in January called a trifecta. Okay, the January trifecta means that it includes years when the S&P 500 generates a positive returns during the Santa Claus rally period, the first 5 days of January, and during the month of January. And all three of those indicators were hit this year. That typically averages a return of equities of 17.4% annually. So that's a pretty good number. And if you're invested in the tech sector, artificial intelligence has really pushed that sector up. So that's actually well ahead of the 17% number. But this also talks about manufacturers, a lot more slow plotters that make consumer products that we use on a daily basis. Think of your toothpaste, shaving cream, stuff like that. And I think we're going to continue to see that. We're going to see strong companies get stronger. I think we're going to see them start to utilize more artificial technology. Artificial technology might be computers, it might be logistics, it might be delivery systems. And I think we're going to continue to see that. But the larger companies have tended to do better in the last 6 years, probably. And we're looking at more U.S. domestic companies. And our fundamental philosophy has not changed. We like large U.S.-based companies that are increasing their earnings and increasing their dividends. That's worked well for us in the past. It's working well for us now. What we're not doing is we're not betting it all in one spot. We're not going to the roulette table and saying, hey, I'm putting it all on red. We want to spread our bets out. We want to make sure that we do some fine tuning along the way. And in our portfolios, we've been very fortunate. We take the Dow Jones Industrial Average, the S&P 500, the Russell 2000, and the NASDAQ, and we take all of those indices and we see what that average is, and then we compare those averages versus the portfolios that we're running. And for the last 6 years that we've been doing this, we've actually outperformed to the downside. So when the market goes down, let's say it goes down 10%, we're only down somewhere around 8%. When the market goes up 10%, we're typically up about 12%. So I hate to sit here and start talking about performance, because once you talk about performance, that's the standard by which you're judged. But our goal is to make sure that our clients are doing well in the markets, whether they're going up or going down. We need to continue to make ground as we move towards our goals. And we've been very fortunate doing that. So if your portfolio is lagging for some reason, please give us a call. We're happy to take a look at what you're doing elsewhere. Doesn't mean you have to do business with us. It just means that you might want a second opinion, second set of eyes, take a look at things. So one thing that I think is kind of interesting as well with these markets is we're coming out of a mini bear market, and the average return coming out of a mini bear market over a 12-month period is 18.9%. So we've looked at a 17% number, we've looked at an 18% number, and these are on average over historical numbers. So I think the winds are in our sails right now. We just need to keep them fully deployed. And the bond marketplace has been an interesting place for, gosh, probably the last 18 months as the Fed has increased short-term interest rates. It's kind of funny. The Fed has a mandate to try to control inflation and try to promote good economies within the United States, but they only have one tool. That tool's a hammer. And that hammer is interest rates. They either raise interest rates in the short term, because that's all they can affect is short-term interest rates, or they reduce interest rates. And when you are increasing interest rates, the goal there is to reduce the amount of money that is flowing freely through the economy and trying to incentivize it to park itself in banks and money markets, which it's starting to do now because we're starting to see short-term interest rates approach 5%. It doesn't help with regard to the overall economy because that one tool is not the only tool that works. We also need fiscal policy to match the monetary policy, because the Fed policy is all about monetary. The fiscal policy is actually controlled by Congress. They seem to really have their eye off the ball right now with regard to the economy because they're out there chasing all these wrongdoers. I'm not going to go into names, but there are lots of folks that are being investigated by Congress right now, and they're not really taking a look at what their constituents are going through on a daily basis. If we were to be able to lower oil prices, for instance, I think we would see inflation start to ease in the economy. That's not going to happen right now because the mandate is, oh, oil is bad, so therefore we need to do away with it, and you're going to reduce the supply, which means the price of it goes up. So again, that's what we need to keep an eye on moving forward, is what is going to affect our companies from making profits on a regular basis and being able to share those profits with their investors. So the yields on cash-like instruments, I just mentioned 5%. 5.1 is the average one-year yield right now. But banks are taking in this money, and then they make money on the loans that they make on the money that's in the bank. Their standards are getting tighter and tighter and tighter. So it makes it more difficult for the banks to actually lend money. And when you're making it difficult for folks to borrow money in order to grow their businesses, that creates a constraint. So again, these are things that we're watching. These are not things that we're overly concerned about, but these are things that need to be addressed in the long run. So the Strategic and Tactical Analysis Unit for LPL Financial has these overall asset allocation recommendations. They're negative on emerging markets, mid caps, small caps, consumer discretionary. Those are things like, hey, we're looking for a new camera, a new video camera. That's a discretionary item. If you're going to go buy shampoo, that's not discretionary. So again, these are consumer items, but you need to make those distinctions. They're negative on real estate, foreign bonds, and investment-grade corporate bonds. They're positive on international equities. That one I kind of question a little bit because I think the international marketplace is still lagging behind the United States. That they may be very early on that call, but they do like the large caps. They like industrials, preferred securities. These are the kind of things I was talking about just a minute ago. These large companies that are continuing to make good profits and being willing to share their dividends with their investors. So that brings us, that's a very, very short presentation with regard to something that could take as long as 2 hours to go through. This is where we've come in 2023, and this is where we think we're headed, because this mid-year outlook, it's a good time to kind of take a pause. It's almost like halftime of a football game. We're going to sit back, we're going to evaluate our strategy, what worked, what didn't work, what do we need to do to change our plays, and we're doing that right now with our clients. We're making some fine-tuning moves with portfolios, and essentially we're trying to look at the macro economic environment, the macro investing environment. And then we start to make micro types of moves with the individual securities. And it kind of goes hand in glove with what I always talk about with investing. We always look at it from 30,000 feet, and then we start to drill down. And when we start to drill down, we're making decisions on individual securities. So if you have any questions on that, if you'd like to come in and see us, our website is www.deaconwealth.com. And our phone number is 540-371-8585. And I invite you to come in, take a look at what we do. If we can help you, we're willing to do it. Hope you guys have a wonderful second half of 2023. We're looking forward to seeing you. There's going to be a few videos coming out. I've been a little busy this summer doing some crabbing, going to the beach, running the dogs, those sorts of things. So we're going to put some fun stuff out there as well. But we need to keep this mid-year outlook kind of front and center right now, to evaluate where we've been. This first 6 months has been very good for us. And that's because the last 2 months of the first 6 months have been good. The first 4 months were awful. So we have to maintain a long-term perspective. And we also need to realize our goal is to keep our clients wealthy. We're not trying to make you wealthy initially. We're trying to keep you wealthy. What you've got, you worked hard for. We want you to keep it. We want you to grow it. You need to be good stewards of your assets. We'd like to help you. So thank you. Have a great day. And again, I'm Darryl Barnes with Deacon Wealth Management. Take care.